Hey, it's Alex here. Welcome back to my channel. And today we're going to talk about what it takes to qualify for a mortgage. So one of the questions that we've been getting is what does it take to qualify for a mortgage? Especially with the interest rates creeping up a little bit, there's been more of a focus on exactly what it takes to qualify. But let's start at the top. And the top is, it is going to be a debt to income ratio. Now, it sounds pretty self-explanatory, and it is, but what goes into it? Well, it depends on what class of income you get. So if you're employed and you're getting a paycheck, how it's going to work is that they use a gross number, meaning above the line. So that if you make $100,000 a year, they're going to divide that $100,000 by 12, and that's the amount that they use as a number to qualify you on. If you're self-employed, it's actually going to be below the line or the net income after all your business expenses because you're not getting a check. Instead, you're actually a business owner. So they're going to look at the last 2 years of your income tax returns and use the net number. Now, when it comes to numbers, what's really important? So there's a front end and a back end. Just like if you were to look at a coin, there's a front and back. So the front end is actually going to be all the expenses relating to the property that you're interested in purchasing. So for instance, if you were to buy a house that was $1 million, then what you're looking at is what is the cost of the mortgage payment? That would be principal and interest. What is the amount of the property taxes, which is usually another pretty big expense, on an annual basis? Any Mello-Roos, if it's in an area with Mello-Roos, such as Irvine, parts of Tustin, small parts of Orange, and Ladera Ranch, San Clemente, those also tend to have Mello-Roos. So it's going to be your mortgage, your taxes, any Mello-Roos there is. If there are any homeowners association fees, that'll be included as well. Also, the cost to go ahead and protect that property, they're going to qualify based on what it costs to insure it. You know, protecting either the exterior if it's a house or if it's a condo or townhome, most likely the cost to protect the interior. So that's the front end, and the front end is definitely important. But I would say, in general, the back end's more important. Now, going back to the front end for just a moment, I forgot to give you what that number is. Typically, it's 36%. That's the Fannie Mae Freddie Mac regulation. So it's 36% of your actual gross income if you're employed, or your net income if you're self-employed. Now, going forward, the other thing is that you got to look at the back end. What is the back end? Well, that includes all your expenses that are scheduled and paid. That would include any car loans, any credit card debt, any personal loans. Also, it will include any student loans that you have, even if the payments are typically deferred. So what you're looking at is a back end of typically 45%. Now, I will tell you, if there's compensating factors, oftentimes the amount can actually be increased. I've seen 50% if it's less than 80% of the value of the property, meaning you're putting down 20%. And lower than that, I've seen debt to income ratios actually up to 55%. Now, that being said, with the cost of everything rising in this inflation environment that we are, so one thing that you do want to understand is look at your budget and really understand what that looks like on a monthly basis so that you can make sure that you're well heeled to offset anything. Because what they do not factor in is the cost of food. They don't factor in the cost of, your gas. So these are all things that you want to think about. But I did want to go ahead and do a quick little refresher because I've been asked more often than not lately about debt to income ratios and how to qualify for a mortgage. Now, if you are considering buying a house, one of the things that we do want to look at is break down exactly what your expenses are, and you can definitely talk to a lender. And we do have lenders that specialize in working with self-employed borrowers as well, and that's important because there might be alternative qualifying standards for you because you may not report all your income, or exactly you have deductions based on your business expenses. So if you have any questions on qualifying, we definitely have a number of lenders that we've worked with that can help you kind of get that done. And if you're considering refinancing as well, we'll be happy to support any way we can. So welcome back to my channel. If you have any questions, let me know. Drop them below, and I look forward to talking to you real soon. Have a great rest of your day, and talk to you later.